About a month ago, the New York Times published an article titled, "When Uber and Airbnb Go Public, San Francisco Will Drown in Millionaires." The article said in essence that the wave of mega IPOs will massively inflate the San Francisco housing market. Over the years, the New York Times Business and Economics section has published many stupid-ass articles, and this was one of the winners. It was pure hype, and it was deeply flawed. It was ignorant even. It willfully neglected to show how the tech industry operates, how IPOs work, and what happens in the years before the IPO. And it ignored history and what happened to the San Francisco housing market after the last two mega waves of IPOs. The article got a huge amount of publicity, and countless people are still to this day asking me what I think about it and are telling me how the coming waves of mega IPOs would incredibly balloon the ludicrous housing bubble in San Francisco and more broadly in Silicon Valley, a housing bubble that has already started to deflate after having peaked in early 2018. So here's what I think, if you haven't figured it out already. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's Sunday, April 7th, 2019. There's a whole gaggle of big IPOs being scheduled for this year. The first one already happened. Lyft went public at the end of March. Uber, Airbnb, and a bunch of others are trying to get the ducks in a row for their IPO. Most of them burn huge amounts of cash and lose money faster than you can count it. Lyft lost nearly $1 billion last year. Uber is losing twice that, so investors are subsidizing each ride. With all these companies that are losing money and are burning cash, it means that investors are in essence paying the user to use the product. So that's the fundamental principle here. The New York Times article says that these IPOs are suddenly creating a tsunami of millionaires out of nowhere, and that the San Francisco housing market is suddenly going to drown under this tsunami of sudden millionaires because these sudden and new millionaires are suddenly all buying homes. The goofy nature of the New York Times article becomes apparent in the first paragraph, and I quote, "Big wealth doesn't come in monthly paychecks. It comes when a startup goes public, transforming hypothetical money into extremely real money." End of quote. But that's not how it works, because this quote-unquote hypothetical money is not hypothetical. It's real. It has been real for years, and it has grown over the years. The equity of these companies has been worth many billions of dollars for years, and those that own this equity have gotten rich over those years just by owning it. And an IPO, if lucky, just inflates the equity value a little further and shifts around ownership a little, and that's all it does. In addition, there's a whole industry that has sprung up around tech centers such as San Francisco and Silicon Valley, where big and small banks alike have entire departments dedicated to converting pre-IPO equity into cash. Not by buying these shares, but by lending money to those people while using the equity as collateral. This money has been out there for years, and these employees have bought expensive homes with this money based on their wealth as equity holders. Do you think the early Uber billionaires are somehow not billionaires just because the IPO hasn't taken place yet? Nonsense. They have been billionaires for years, and their millionaire underlings have been millionaires for years as well, and they have already bought expensive homes based on their wealth. In addition, employees of these startups have been able to sell their shares. There is a secondary market for the shares of startup companies. Startup companies also set up programs to buy back those shares from employees. And during fundraising rounds, employees can often sell their shares to new investors, thus cashing out at least some of their wealth. And they too bought expensive homes years ago. In addition, and this is the biggie, the biggest winner in an IPO are the institutional investors. The early investors are venture capital funds. Their money comes from around the globe. They invested this money in a startup that is now worth tens of billions of dollars, or even north of 100 billion, as in Uber's case. When they sell those shares to the public during and after the IPO, they will make huge gains. But this is not San Francisco money. This is global money, and it gets distributed where it came from, globally. Then there are late-stage institutional investors. They include private equity funds and mutual funds. This also is global money, not San Francisco money. And once they're selling their Uber shares, the proceeds go to the investors globally. And there's more to it. These employees that have worked for Uber and other startups for years and that are millionaires based on their stock compensation plans have been millionaires for years. Do you think they still live in some dumpy apartment with 3 other roommates? Hardly. They have already cashed out some of their wealth, and they've already bought expensive homes based on this wealth. This home buying by these wealthy startup employees has been in part responsible for the ludicrous surge in home prices in San Francisco. It is precisely what drove the housing bubble. This means that it's already baked into the cake. They're unlikely, all of them suddenly, to go out and buy an even bigger home, and even if they did, they'd have to sell the home they're in now, and they'd be merely circulating homes, not creating new demand. Only first-time buyers create new demand, but people selling their home and buying another home don't create new demand. They're just churning the market. Sure, there are some recently hired employees whose shares and stock options are going to be worth $50,000 or $100,000 or $200,000, assuming that the IPO shares don't crash. Good for them. And maybe some of them can use this money for a down payment on a ludicrously overpriced home. So they will buy a median apartment that may run them over $1 million, and they'll try to make huge monthly mortgage payments, and they pay homeowners association fees out the wazoo, and they pay property taxes on that inflated home price, and they're paying out of their nose for everything. And they have a good chance of losing money on their home because this is precisely how it happened during the last 2 big IPO booms. The IPO boom in 1999 and early 2000 led to the same kind of silly speculation of Silicon Valley and San Francisco drowning in millionaires and inflating the housing market further. But then the bust came, and these people lost their jobs and couldn't afford to live in the area without a job, and they packed up and left. And some tried to dump their homes, and others just defaulted on the mortgage and walked away. And suddenly San Francisco began to empty out. And the housing market, instead of being further inflated by all this IPO money, as promised, took a hard dive. And the same kind of hype about IPO money further inflating an already ludicrously inflated housing market happened in 2006. And by 2007, the San Francisco housing market started to crash. In each case, the post-IPO money did the same thing. One, for institutional investors, that's the global money, and the proceeds from the sale of the shares in the IPO or after the IPO went to global investors. And 2, founders and employees that had gotten rich years earlier of those shares and had bought homes with that wealth, and that had driven up the market, and their buying activity had already been baked into the market and was in part responsible for driving up the market before the IPO. And when the startup boom crashed, as it always does, the housing market dove with it. That's how it happened the last 2 times. And how often are we going to forget the same story? Is it going to be different this time? Hardly. What these mega IPO waves tell us is this. It's the peak of the market, including the peak of the housing market, because all this money of these hugely hyped up startup valuations has already been baked into the cake. And it's the moment when global investors, the VCs, the private equity funds, and the late-stage institutional investors are trying to cash out and let the public hold those shares. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com. Thank you for listening to the Wolf Street Report.